Welcome again. Next test your understanding is 5 from the Kaplan study text. Topic, remember, is inheritance tax. During his lifetime, Alex has made the following gifts. On 30th June 2012, 1,70,000 to a trust. On 12th June 2016, 1,50,000 to his daughter. Again on 30th June 17, 1,91,000 to a trust, and 15th December 2022, 2,56,000 to a trust. The trustee of the first two trusts paid the IST liabilities. Alex paid the tax on the last gift. Nil rate band in these year is 3,25,000 in every year of gift. Calculate the IST arising as a result of Alex's lifetime transfer. State who will pay the tax, the due date for payment, and the gross chargeable amount of each gift to carry forward to future computation. So, the format is the same that we have considered in yesterday's lecture. First, we have to mention the type of transfer. So, first gift is said to be the potential exempt transfer. Date of gift is 30th June 12, tax year is 12/13. First, we have to mention the transfer of value. And the gift has a value of 1,70,000. 1,70,000. Then we have to deduct the annual exempt amount of current year 3,000, and then annual exempt amount of previous year, because there is no gift in the previous year. It means the previous year's annual exempt amount is unused. So, now the chargeable amount is 1,64,000. First gift is first gift is to the trust, so it is not a potential exempt transfer, it is chargeable lifetime transfer. First gift is not a potential exempt transfer, this is to trust, and a gift to trust is an example of chargeable lifetime transfer. As in the previous year, there is no transfer of gift. So, it means the whole nil rate band is available, the whole nil rate band of 3,25,000 is available. No doubt nil rate band is for 3,25,000, but our chargeable amount is as only 1,64,000. So, it means that only 1,64,000 worth of nil rate band is to be utilized. So, as a result of deducting or using the nil rate band of 3,25,000, the taxable amount becomes nil, 0, right? And as the taxable amount is nil, there is no IST that is payable. IST payable is also nil, no IST to be payable. And then we have to consider in accordance with the format, who has to pay that, because there is no tax. So, no one has to pay that, and we have to mention the due date of payment. As the date of gift is 30th June 12, so the following 30th April 2013 is said to be the due date, but there is as no tax payable. So, that is why there is no need to mention due date as well. Then it is gross chargeable amount. So, as a gift is a gift to trust, the gross chargeable amount is 1,64,000. Actually, the gross chargeable amount depend upon whether the tax is paid by the donor or donee. So, in that case we have to consider the amount of tax as well, in case what amount should be added to the chargeable amount to calculate the gross chargeable amount. Here there is no amount of tax that is to be paid on this gift. So, there is no change in the chargeable amount and gross chargeable amount. Now, about the second gift. The second gift is the potential exempt transfer, because this is a gift to a daughter. So, the date of gift is 12 June 2016. First we have to mention that this is potential exempt transfer. Date of gift is 12 June 16. So, the year is 1617. The amount of gift is 1,50,000, right. This is the amount of gift, 1,50,000. Now, you have to deduct the annual exempt amount for the current year 2016-17, and that is 3,000. As there is no transfer of gift in the previous year, means in the previous year 15-16. So, it means that previous year's annual exempt amount is also available, it is unused because there is no gift in the previous year. Remember that annual exempt amount is for every year. If there is no gift in the previous year, it means the annual exempt amount of previous year is unused, right. So, it will be 1,44,000 annual chargeable amount. As this is a potential exempt transfer, so remember that nil rate band is not applicable on the potential exempt transfer. Remember, nil rate band is not applicable, not used for those gifts or for those transfers which are said to be potential exempt transfers. So, nothing is to be mentioned here. The taxable amount is 0, no HT is payable, nothing has to be paid by anyone, there is no due date, and the gross chargeable amount is the same, that is the chargeable amount means 1,44,000, right. Now, in the third case, the third gift is on 30th June 17, 1,91,000 and to a trust. So, first we have to consider that if it is a gift to a trust, then it is chargeable lifetime transfer. The date of gift is 30th June 17. So, the tax year is 1718. Transfer of value is 1,91,000, right. Now, you have to deduct the annual exempt amount of current year 3,000 only. There is no unused annual exempt amount of previous year. Why so? Because in the current year it is the tax year 1718, the previous year is 1617, and in the previous year 1617 the annual exempt amount of that year has been utilized. So, that is why there is no annual exempt amount of previous year. So, the chargeable amount is 1,88,000. As this is a chargeable lifetime transfer, so we need to apply the nil rate band. Nil rate band is 3,25,000, and we have to consider the nil rate band utilization in previous 7 years. But we have to consider how much our nil rate band has been utilized in previous 7 years. So, if we consider the year tax year 1718, the previous 7 year period includes the tax year 1213, and in this tax year the nil rate band of 1,64,000 has been utilized. Nil rate band of 1,64,000 has been utilized. The total nil rate band is 3,25,000. Out of this, 1,64,000 of nil rate band has been utilized in the previous 7 years. So, how much remaining unused nil rate band available in this current year? So, this is 1,61,000. So, 1,61,000 of nil rate band is available. So, this nil rate band will be utilized against the chargeable amount. and it will reduce the taxable amount to 27,000, right. Now consider the information in the question. The trustee of the first two trust, so the gift on 30th June 17 is the second gift to a trust. So in that case the trustee is agreed to pay the tax liability. So in accordance with that, if the trustee is agreed to pay the tax, the rate of tax is 20%. Remember that if the donor has to pay, the rate of tax is 25%, but if the donee has to pay, the rate of tax is 20%. So 20% of 27,000 will be 5,400. So 5,400 is the IST payable, paid by trust, and as the date of gift is 30th June 17, the due date would be 30th April 18. Following 30th April is said to be the due date. Remember the rule. Now what is the gross chargeable amount? Again the gross chargeable amount is same as chargeable amount. Remember one rule, that if the donor agree to pay the tax liability, in that case the amount of tax is added in the chargeable amount to get the gross chargeable amount. If the donor agree to pay the tax, then amount of tax is to be added in the chargeable amount, then gross chargeable amount would be different. Now this is the third gift, and fourth gift is again, and this is a gift on 15 December 2022, 2,56,000 to a trust. So if it is a gift to a trust, then it is said to be chargeable lifetime transfer. 15 December 2022 is the date. So the tax year is 22-23. The amount of gift is 2,56,000. The amount of gift or transfer value is 2,56,000. First we have to deduct the annual exempt amount of current year, which is 3,000, and as in the previous year, in the tax year 21-22, there is no gift, there is no transfer of asset, then it means that previous year annual exempt amount is also available. So the chargeable amount comes to 2,50,000, right. Then again remember the fact that what is the amount of nil rate band that has been utilized in previous 7 year, that is to be considered. So if the tax year of CLT is 22-23, if the tax year of current year gift is 22-23, we have to consider 7 year back, means up to 15-16, up to the tax year 15-16 have we utilized the nil rate band. So up to 15-16 this utilization will not be considered because it is more than 7 years old. We have to consider in the date of in accordance with the date of gift, that in previous 7 year whether we have utilized the nil rate band or not. Here I am mentioning that the date of gift is 15th December 2022. So we have to consider 7 year before, means from 15 December 2015 whether we have made any contribution, any CLT contribution, any chargeable lifetime transfer. If so, whether we have utilized the nil rate band, what is the amount of nil rate band that has been utilized, right. Now consider that in 2016-17 it is a potential exempt transfer, in 2017-18 it is the chargeable lifetime transfer. So nil rate band is applicable or applied in the case of chargeable lifetime transfer. In 17-18 1,88,000 of chargeable amount and 1,61,000 of nil rate band has been utilized, right. But you do not have to consider this amount of 1,61,000. You do not have to consider that out of 3,25,000 you have to deduct 161. No. In the year of application of nil rate band, what is the gross chargeable amount. This gross chargeable amount of the year of application of nil rate band is to be deducted. So, we have to deduct 1,88,000 of nil rate band. Does not matter what is the amount actually used as nil rate band in the previous 7 years. We have to consider that if the nil rate band has been utilized in any of the previous year, what is the gross chargeable amount in that year? That gross chargeable amount is to be deducted. This is the important point you need to remember. So, here in case in previous 7 year, this is the gift of CLT, right, and this in this year the actual nil rate band utilized is 1,61,000, but we do not have to consider this. We have to consider what is the gross chargeable amount in this year, and that is 1,88,000. So, we have to deduct 3,25,000 1,88,000 from 3,25,000, and remaining would be 1,37,000. So, this 1,37,000 of nil rate band is applicable here. This is said to be unused nil rate band. When this is applied, the remaining value of gift is 1,13,000, which is said to be the taxable amount. 1,13,000 is said to be the taxable amount. And as the donor agreed to pay the tax, where it has been mentioned Alex paid the tax on the last gift. So, as Alex is ready to pay the tax, the rate of tax is 25%. So, we have to calculate what is 25% of 1,13,000. So, it is 28,250. 28,250 is the amount of tax. It is to be paid by Alex, and as the date of gift is given to you as 15 December 2022, we have to consider that what is the due date of payment. First, we have to consider what is the last date of December. Last date of December is 31st December, and then we have to add 6 months period. So, that is how the due date is to be determined, and this will be 30th June 2023, right. And in case of tax is paid by donor, then the amount of tax is to be added to chargeable amount to find out the gross chargeable amount. In case donor agree to pay tax, then in the chargeable amount we have to add the tax to find out the gross chargeable amount. So, in this case this is 2,78,250. So, this is how it has to be solved, right. So, these are the rules that needs to be remembered. After that, we will consider the next taxation understanding from the Kaplan study text, and that is taxation understanding 6. This is the taxation understanding 6. During his lifetime, Yomov had made the following cash gift: on 21st April 2010, 98,000 to a trustee to pay tax; 15th April 16, 1,40,000 to his son; 19th March 17, 2,34,000 to a trust, Yoma to pay tax; and 9th May 2022, 3,95,000 to a trustee to pay tax. The whole question is same like that taxation understanding. There is only difference is that instead of last gift, the donor has to pay tax in the taxation understanding 5. Here in the third gift, the donor has to pay tax. So, I suggest you to try this and solve this. If there is any problem, ask me, and we will consider taxation understanding, next taxation understanding instead. But before doing the next point, we have to consider the taper relief. What is taper relief? Where IHT, inheritance tax, is chargeable on any lifetime transfer due to death within 7 years. Remember that one type of gift is chargeable lifetime transfer, other type of gift is potential exempt transfer. Potential exempt transfer is said to be potential exempt because it has a potential to become exempt if the donor survive 7 years after the date of gift. But if the donor die within 7 years, the amount of IST payable on death is reduced by tapper relief. So, if the period we have to consider year before the date of that, if it is from 0 to 3 years, then there is no tapper relief. If it is 3 to 4 years, then the tapper relief is 20%, means 20% of tax is given as relief. Then if a period of year before date of death is between 4 to 5 years, then the tapper relief is 40%, 5 to 6 year 60%, and 6 to 7 year it is 80%. So, if the donor dies between 6 to 7 years after the date of gift, then there is a 80% relief in the tax payment, 80% relief in the IST payable. So, next illustration is Fred had made the following lifetime transfer: 31st July 2013, 80,000 to his son. So, it means that this is the potential exempt transfer. On 31st January 2016, 1,10,000 worth of gift to his daughter, and then again on 30th April 2016, 2,35,000 to his son. He died on 31st December 2022. So, the nil rate band for the earlier years are, in all these years, the nil rate band is 3,25,000, means in the year 13, 14, 16, 15, 16 and 16, 17, the nil rate band is 3,25,000. Calculate the IST arising as a result of Fred's death on 31st December 2022. State who will pay the tax and the due date of payment. So, first we have to consider what is the amount of tax that is to be paid, or what is the gross chargeable amount, because these are all potential exempt transfer. What is the gross chargeable amount on these gifts? So, the pattern is same. First we have to mention the date and the potential exempt transfer. Type of transfer is potential exempt transfer. Date of gift is 31st July 2013, 31st July 2013. So, tax year is 13-14, right. Now, the transfer of value, we have to consider the transfer of value. Transfer of value is 80,000. So, we have to deduct the annual exempt amount of current year, that is 3,000. Then annual exempt amount of previous year, as there is no gift, there is no transfer in the previous year, it means that previous year's annual exempt amount is unused. So, we have to utilize this, and after that the chargeable amount, and that is 74,000, right. Remember that this is the potential exempt transfer. So, there is no need to apply the nil rate band. So, that means that the gross chargeable amount remains the same. So, you only have to mention that there is no IST that is to be paid, right, and the gross chargeable amount is same, 74,000. Now, we have to consider the second gift. Second gift is again potential exempt transfer. Date of gift is given to you as 31st January 2016. So, it means the tax year is 15-16, right. So, the transfer of value is 1,10,000. Current year annual exempt amount is 3,000, previous year annual exempt amount is also 3,000, because in the previous year 14-15, in the previous tax year 14-15, there is no transfer of gift. So, that is why previous year annual exempt amount is available. So, this is 1,04,000, As this is a potential exempt transfer, so no IST is to be paid. The gross chargeable amount is also 1,04,000. Now the third gift, this is also potential exempt transfer because this is a gift to his son again. The amount of gift is 2,35,000 and date of gift is 30th April 16. So if it is 30th April 16, the tax year is said to be 1617. Amount of gift is 2,35,000. So gift is for 2,35,000. You have to reduce this by the annual exempt amount of current year, which is 3,000, and the previous year annual exempt amount is not available because in the previous year 15-16 annual exempt amount has been utilized. So that is why only current year annual exempt amount is to be reduced from the 2,35,000 transfer of value, and the chargeable amount is 2,32,000. As again this is a potential exempt transfer, no IST payable, and 2,32,000 is a gross chargeable amount, right. So in case of potential exempt transfer and you have been given that the donor become there is a death of donor given to you at any particular date, first you have to consider what is the gross chargeable amount or what are the gross chargeable amount on these potential exempt transfer. Next step, you have to consider the date of death. The date of death is given as 31st December 2022. The date of death is given 31st December 2022. So you have to consider the previous 7-year gift, the previous 7 years potential exempt transfer, now they become chargeable. So from what date you have to consider? The date before 7 year is 31st December 15. So you have to consider the gift which are transfer of value or which are said to be gift transfer to the daughter to individual person between 31st December 15 to 31st December 22. So here consider this potential exempt transfer becomes exempt. Why so? Because it has a potential to exempt transfer in case the donor survive within 7 years after the date of gift. So the gift is made on 31st July 13 and after that up to 31st July 20 the donor survives. So this gift become exempt, right. But these two gifts become chargeable because these has a potential to exempt in case if the donor survive after 7 years the date of gift, but the donor become dead. So that is why these potential exempt transfer become chargeable. So in that case you have to consider this potential exempt transfer, first potential exempt transfer that become chargeable, that is on 31st January 16. And now you have to start your question from the gross chargeable amount, not from the transfer of value, from the gross chargeable amount, and the gross chargeable amount is 1,04,000. So you have to start question from 1,04,000 and now you have to apply the nil rate band, because nil rate band is not applicable on potential exempt transfer because they have a potential to become exempt, but now they become chargeable. So you have to apply the nil rate band. Nil rate band available is 3,25,000, but out of this only 1,04,000 of nil rate band is utilized. So there is no IST payable on the date of death because of the nil rate band. So you will consider that there is no IST payable and if there is no IST payable, it could not be reduced due to the taper relief. There is no taper relief available because there is no IST payable, right. Now the second gift, potential exempt transfer, that was on 30th April 2016. The amount of gift is not to be considered. We have to consider the gross chargeable amount, which is 2,32,000. And now consider the previous gift has utilized the 1,04,000 worth of nil red band. The previous gift has utilized the 1,04,000 worth of nil red band. Remaining 2,21,000 of nil red band is available. So this nil red band reduced the amount of the taxable amount to 11,000 only, right? It is reduced to 11,000. And remember one more thing, if it is a potential exempt transfer that becomes chargeable at the result of as a result of death of the donor, the IST payable, the rate of IST payable is 40%. The rate of IST payable is 40%. So you have to consider 40% of 11,000, that is 4,400. Now consider the date of gift is 30th April 16. The date of gift is 30th April 16 and date of death is given to you 31st December 22. What is the time period between these two dates? It is 17, 18, 19, 20, 21, 22. So this is the period between 6 to 7 years. This is a period between 6 to 7 years. So that means 80% of taper relief is available. So 80% of tax is to be reduced. 4,400 is the total amount of tax, which is reduced by 80%, means 3,520. And this is actually not payable, this is actually said to be IST. 4,400 reduced by taper relief and now it becomes only 880, that is said to be IST payable. Now question is, who has to pay that tax? Who has to pay this? So this is to be paid by son, because son has received that gift. And what is the due date? Due date is said to be, the date of gift is 30 April 2016. So following, if the date of gift is between 6th April to 30th September, the due date is 30th April 2017, but this is the case of death of the individual. So in case of death of the individual, we have to apply the same formula, that what is the date of death and add 6 months to that. What is the date of death and add 6 months to that. So it is the due date of 30th June 2023. So that is how it has to be considered. Again remember that if this is a potential exempt transfer and you have been given that the donor become die later on, you have to consider which potential exempt transfer become chargeable. And which potential exempt transfer become chargeable? If the donor die within 7 years of date of gift, then the potential exempt transfer become chargeable. So that is why the first gift that was made on 31st July 2013, it become exempt on 31st July 2020, and at this date 31st July 20 the donor was alive. So that is why this gift become exempt. But the other two potential exempt transfer, like the gift made on 31st January 16, it becomes exempt on 31st January 2023. But before that date, on 31st December 2022, the donor die. So that is why this gift become chargeable. So first we have to calculate the gross chargeable amount during life, and then we have to consider those gifts that become chargeable and start our question from gross chargeable amount, apply nil red band, find what is the amount that is to be paid as that is taxable amount, apply the IST rate, which is 40% on the date of death, and if there is a time period involved more than 3 years to 7 years, then you have to apply the taper relief as well. And then after that the IST payable, and who has to pay? Donee has to pay tax, and the due date is said to be 6 months after the date of death.